Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. The Federal Reserve is on my mind, and I know it's on yours. What we need to understand is this battle in between what we are looking at with inflation, potential recession that follows, and of course, all the activities in between. Is it possible that we could see a major rally in the stock market in the second half of this year? That's what we need to discuss. Let's begin. Fed's inflation fight gets a boost amid the Wall Street rout. Inflation expectations fall as financial conditions tighten. Market is showing some faith in the Fed's credibility. So that's where I wanted to begin, and I want to show you the details. I'm going to look at the Fed funds rate. I'm going to show you historically what has happened and understand the depth of what the Federal Reserve is actually trying to accomplish. Not what you see out there in the mainstream media. That's why you got to stay tuned for the truth. Looking at this with ever tightening financial conditions and the draining of stock market froth, important note there, by the way, suggests that Wall Street is taking the Fed's hawkish stance seriously, a development that should eventually help cool the expansion. So let's take a couple points from this right now. Number one, the froth. When I had talked about it over and over and over again, if you look at it historically, PE ratios, based on any sort of metric or indicator you want to use, the stock market was way overvalued. But you look at some strong companies, some actually good companies, while they were also above and beyond where they should be, there were some serious outliers, okay? And those stocks have come down significantly. Some of these stocks well over 50%. Okay. And you look at other examples, 75% and even greater. So the froth, no doubt, has come off. Okay. That's clear. That doesn't mean that it's suddenly going to change. What happens historically? The sine wave is something, if I can draw properly, that is something that we cannot ignore. We can't ignore it in nature, in electricity, in everything. It's there. And this is the way it goes. Because you have a period, my line's not straight, but you have a period in which things get out of hand on the way up. But guess what? They get out of hand on the way down. But they are always reverting to the mean. Not the meme, not reverting to the meme, okay? That's an old joke for my friends out there. But anyway, looking at this, they always revert to the mean. On the way up, on the way down, they always find their way there. So I think it's important to see where we go from here at this point. We went excessive on the way up, but now, what could happen for the way down? It's not all good news, clearly. Amid the stock slump, big retailers are seeing their earnings weakening as inventory buildup grows. While that may suggest a shift in spending habits from goods and services, easing supply side bottlenecks, any softening in demand from the American consumer would hurt the business cycle just as U.S. rate hikes kick in. There is a whole bunch of things that are adding up right now at this time that are not looking good. We'll talk more about that. One of the things is the Fed funds rate, or the main interest rate for the Federal Reserve, the central bank of the United States. And, this is 1980, 81, and we look clearly, interest rates had peaked out during this period of time. But even if we were to, chop that down to kind of be a little bit less aggressive, just look at the direction. I think that's the most important factor here. What was the direction? Well, first of all, we watched interest rates throughout the period in the 1970s where they didn't take it seriously enough. And as a result, they needed to increase interest rates dramatically to actually signal to the markets, the economy, and so on, that they meant business. The first set of rate hikes didn't take. That's important to note. At the same time, you look at the direction, you look at the trajectory that we are experiencing today, and come on, it's obviously there now. You probably can't see it, but this little tiny blip on the screen, that's interest rates today. So the Fed funds rate is at a super low right now at the time of this recording, 0.33. But where they are is 1% essentially, okay? 1% on the interest rates. They're expected to get to 2%, 2% in interest rates by the July meeting, okay? Remember, you keep all these days in mind. I'm going to give you all the details you need to know in this video. Make sure you hit that thumbs up because I will give you each and every step of the way. July, 2% in July. Now that is significant because think about where we are with mortgage rates. I think I have an article pulled up right here. So let's say we're at 5%. Just bear with me, okay? Round numbers. 5%. If we see interest rates at 2%, Fed funds rate, where are we going to be at with mortgage rates? Are we at 6%? Are we at 6.5% maybe? Is that possible? Certainly possible. And then you look at areas like Canada, the UK, Australia, New Zealand, where interest rates, and other places too, interest rates were, in many cases, 1%, 0.99%. What does it do when we start to watch mortgage rates increase? Well, the payments that people are making start to go from, round numbers here, $1,000 to now $2,000 a month. Same house, double the payments. Do you see a problem with that? Okay, but what changes here? Well, of course, if the Federal Reserve changes their tune, well then, we have a story for you. Most Fed officials have embraced raising rates to a neutral setting. Neutral. Okay, that's what they talk about. They have no idea what neutral means. The market doesn't either. Economists have no idea, but it's a word they love to use, which neither speeds up nor slows down the economy this year. The FOMC estimated that at 2.4% in quarterly forecast updated in March. So that's where they want to get it to. They want to get it to 2.4%. All right, 2.4%. That's great. Great number, right? What was interesting about 2.4% is that that's where they got it to in the previous cycle. Previous cycle, around 2.4%. So they want to bring it up there. If you ever saw, I've shown a couple times before, the dot plot. The dot plot is so funny because that's kind of where all of the Federal Reserve participants come in and they say where interest rates are going to be at the in the near future. They do a little light bright. You remember light bright? They do kind of that sort of thing, and it's supposed to tell you where you can expect the Fed funds rate to be at in the future. Now, it has never once been accurate, by the way, and I think that's important to note here at this time for this video. Powell and the other Fed officials have said that they are willing to go well past that level if necessary to cool prices, though the pace of increases could slow. So imagine they were going at the 50 basis points. They think they're there, but maybe they're going to go 25 basis points for that last hike. I want to make it very clear right now, while you are still watching the video, I know it's important to keep the pace in my own videos. What we're looking at here is a June meeting. Okay, you got June 50 basis points. Okay, June 50, July 50, and then we come to September. And September is a time in which they might actually pause. They might pause, and I'll show you why in just a second. I got to reveal that for you each and every step. Stay with me. My view is and remains that the Fed will pivot during the summer. The Fed's deep DNA of growth and market preservation will resurface. Okay, this is not actually a fact. I want to make that very clear. The Federal Reserve does not push the markets up. They control the markets. It's a sine wave. Always remember, it's a sine wave. It is not perpetual growth. We learned that lesson in 1929, in which the markets came down by 89%. Okay? Financial conditions have tightened almost 300 basis points since September 2021, a faster pace than seen in 2014 to 2015, as well as 2018. Look at this. Look at that. 2020's time frame. You saw that. And what happened? Currently, though, it is right here. Net change in financial conditions during these tightening periods. So to me, it just shows us things are very, very different than where we were at, a year ago. So, of course, we have, when you look at these financial conditions, they're made up of different aspects. Okay. It's not just Fed funds rate, there's a lot to that. But it's important to note this. Here we have it. Here's how the Fed might adopt Bostic's rate pause in September. Clear and convincing evidence of slowing inflation is a must. Slowdown in growth and jobs also a condition to halting rates. So Bostic came out and basically said, if they had the quote in here, I know I was reading in another article, but right there, which Bostic said on Monday that it might make sense to pause at the Fed September 20th, 21st meeting. Will probably require two tough conditions to be met: inflation slowing meaningfully and signs that the US economy is cooling enough to reduce future price pressures. So there you have it. If you look at what one individual in the Fed is saying, they usually project this out into the media through interviews, through conferences, and so on, and so that it starts to make its way around and then the market reacts to that information. That to me is clear. That to me is showing what we could be experiencing here in the future. Now, I've gone on and on, but I hope that I've made my point very clear. What we can see, if I can summarize it right now, is that we do have rising interest rates. And what is this being met with? Rising inflation. Rising inflation. If we start to see inflation go sideways and potentially even down somewhat, the Federal Reserve doesn't have to do 50, okay? They don't have to go in with a 50. They could say, you know what, this time we're going to do a 25. And maybe that comes as soon as July. In fact, the market participants are starting to reduce the expectation of a 50 basis point cut at the July meeting. So what does that mean? They believe that inflation is coming down. Now, let me tell you, I shouldn't need to say this at this point, but I'll say it anyway. When I talk about inflation, I'm talking about their measurement of it. I'm not talking about real inflation, obviously. I mean, come on. But anyway, this is just showing us where we are today. I've given you the entire path. This means the Federal Reserve at, let's say, 2% could very well be the maximum where they get to. Inflation perhaps subsides slightly, and the Federal Reserve puts the pause on. The actual recession could start to happen. We could start to see the slowing growth, could see the housing market tip over, and then the Federal Reserve starts to cut interest. Interest rate, what they were doing, and the quantitative tightening whole policy, all of that, they stop. They stop all of that. The markets, in response, historically since 2009, have been very positive to that. And then we could see particular elements of the stock market go up. Particular elements. So that, my friends, is everything you need to know right now. I kept it focused. I kept it detailed. I outlined exactly what what we can see potentially happening. Nobody knows the future. But this, of course, will be something that I can reference back to. I hope you appreciate it. If you did, hit that thumbs up button. Do you want to know the truth? Do you want to know the full explanation? You got to hit that subscribe button. It's right down there. If you want more data throughout the day, I post on Twitter all the time. I give you all kinds of information that you need to know. So check me out at the Money GPS. I'll see you on the next one. Take care.